Disclaimer: $59.32, silver just shattered every record in history. December 6, 2025, today. But here's what caught my attention. While this was happening, JP Morgan reportedly moved approximately 169 million ounces into their vaults. Industry sources suggest this represents roughly 9% of global supply. They've been accumulating since 2011, 14 years, quietly. Now I keep asking myself, if silver doesn't matter like so many experts claim, why would America's most powerful bank be hoarding this metal? My theory: something significant might be unfolding. And I want to walk you through a pattern I've been studying, one that's appeared in every major financial crisis in history, a pattern that's never failed. And right now in my analysis we might be watching it complete in real time. Data from mining reports show supply has declined roughly 7% since 2016. Analysts point to what they call a structural deficit, more silver consumed than mined for around 7 consecutive years. So where's the difference coming from? Above ground stockpiles, vaults, reserves, they're being drained. India's silver imports reportedly hit record highs. China's been purchasing consistently, but paper prices stayed suppressed until recently. Now this is where it gets really interesting to me. According to various market reports, since around April 2011, JP Morgan has accumulated what some analysts estimate at 675 million ounces of physical silver. If these estimates are accurate, that could represent roughly 45% of the world's above-ground supply in 1,000 bars. Let me put that in perspective. That's reportedly more than the Hunt brothers held at their peak. More than what Berkshire Hathaway ever held, more than entire nations. Why would they do this? Here's my understanding of what happened. Back in 2010, JP Morgan reportedly settled manipulation charges for around $200 million. When they acquired Bear Stearns in 2008, they inherited significant short positions. For years, they were apparently on the wrong side of the trade. So what did they do? According to market observers, they flipped, covered their shorts, went long, massively long. Recent COMEX data suggests they're now sitting on approximately 169 million ounces in COMEX vaults alone, which could represent around 40% of total COMEX inventories. In my view, the gap between paper and physical has never been wider. Stage 3 is what I call the break. Something fails. Could be technical, could be political. Suddenly everyone wants the real thing, the physical asset, not the paper promise, and there isn't enough. And here's what makes me nervous. I think we're watching stage 3 unfold right now. Let me show you what I mean. November 28, 2025, the CME Group, the exchange handling derivatives, reportedly went down due to what they described as a server cooling issue. Reports indicate the outage lasted over 10 hours. During that outage, according to trading data, silver spiked to approximately $56, $72 per ounce, an all-time high at that moment. When systems came back online, market observers noted bid-ask spreads were over $1. Now, I'm not a professional trader, but that looks like chaos. That's what illiquidity looks like. That's what happens when a paper market faces stress. Then just days later, something caught my attention. According to COMEX filings, JP Morgan reclassified around 13.4 million ounces from registered to eligible status. Let me explain why this matters. Registered silver is available for delivery against futures contracts. Eligible silver is just stored there. It's not available for delivery. Think about the timing. JP Morgan reportedly pulled roughly 9% of deliverable silver off the table during peak physical demand. That tells me something. October 2025 market reports showed silver lease rates hit approximately 30% annualized. That means people were apparently so desperate for physical silver, they'd pay around 30% interest just to borrow it. That's not normal. That's what a squeeze forming looks like. December 6, 2025. Today, silver hits 59.30s. Reports suggest this is approximately a 98% gain year to date. The strongest annual performance since 1980. Stage 4 is what I call eruption. Price explodes. Shorts get crushed. Institutions positioned early win big. Everyone else scrambling. This is where I believe we are right now. And this is where history becomes crucial. Let me tell you about Texas. 1979, two billionaire brothers, Nelson and William Hunt, they looked at silver trading around $6 per ounce and saw something others missed. Inflation, consumption exceeding production. A perfect storm. So they bought approximately 200 million ounces, around 1/3 of America's entire silver supply at the time. Then January 1980 arrived. According to historical records, silver hit 49.45. That's roughly 800% in 18 months. Banks panicked. COMEX changed the rules overnight. Banned new long positions. Forced liquidation only. Silver Thursday, March 27, 1980. Crash. The hunts were destroyed. But here's what I think matters most. The squeeze was real. The shortage was real. And the $49 price was real. It literally took changing the entire game to stop it. Now imagine something with me. What if the buyers weren't two reckless billionaires? What if it was the bank that helps make the rules? That might be what's happening right now. 2008 taught us a similar lesson. Paper mortgage securities collapsed when everyone wanted real assets simultaneously. Historical data shows gold was trading around $720 per ounce in October 2008. By September 2011, it reportedly hit $923, approximately 167% surge. Why? In my view, when paper promises fail, money flows to physical reality. Gold, silver, real assets. And here's what concerns me about 2008. The central banks didn't fix the underlying problem. They just made it bigger. Reports suggest they printed around $16 trillion globally. They bought their own debt, suppressed interest rates to zero, expanded paper markets even further, which brings us to today. Silver is consolidating just below $60s. But let's talk about what could happen if it breaks through.
According to reports, JP Morgan's earlier projection suggested around $38 by late 2025. We're already roughly $21 above that. Citibank analysts reportedly called for $36 to $39. Those targets have been Some independent analysts like Lawrence Leopard have mentioned targets of $75 to $90 by end of 2026. But those are conservative numbers. Those assume the paper market holds together. What if it doesn't? Remember the Hunt brothers? Silver hit around $49 in 1980. When you adjust for inflation, that's approximately $170 in today's dollars. We're currently at 59. But consider this. The supply deficit appears worse now, industrial demand is higher now, and the paper market is exponentially larger now.
Done. Stage 2, expansion and debasement. Done. Stage 3, the crisis happening now. Stage 4, the inevitable outcome, loading. You don't have to believe me, but you should study history. And history has a way of repeating. I'm not a financial advisor. I'm just someone who's been studying these patterns, watching these markets, trying to make sense of what's happening. The silver situation isn't coming. It's already here. The only question is whether you're positioned to understand what's unfolding, or whether you'll look back in 6 months, wishing you'd paid attention. The choice is yours, but think carefully because December 9th is 3 days away. If you want to follow along as this unfolds, hit subscribe. I'll be tracking developments and sharing my analysis in real time as we watch this situation develop. Do you think silver hits $100 in 2026? Drop your thoughts in the comments below. I'm genuinely curious what you all think. This might be one of the most important financial stories of 2025.